At least once a week, always before I write the weekend report, I always look at the long-term charts to just get an idea of where the markets are really going. Very few people, especially retail traders, they're lost in these daily movements, and they never bother to step back and look at the forest. And so in this video, I'm just going to take a long-term look at several of these markets. So the first one here is oil, and it's pretty clear we've got a 3-year cycle low back here in 2016. And we bounced up to 55 during this intermediate cycle. We've got another intermediate cycle here. We're at 55. My expectation is, let me widen this chart out just a bit more. My expectation is that oil is probably stuck in a trading range for maybe a long time. I'm anticipating the top of the range is going to be right in here around $60 to $62. That's kind of where my target has been for this intermediate cycle advance. We're at a major resistance zone right here though, so I suspect we're going to have to move down into a daily cycle low first before one more move up. But this just looks to me like oil is probably, the fundamentals are a little bit impaired. The improvements in fracking have just made supply abundant, and barring a major collapse in the US dollar, I think oil is probably just going to be stuck between $60 or give or take a few, and $40 on the downside. So 60 on the upside, 40 on the downside, maybe for years. I don't know, but so the only way to make money in this market is you have to sell when you're in the top of the range, buy in the bottom of the range. It's just not a market that's, in my opinion, that's likely to develop a strong upwards or downwards trend. So it's probably just going to be difficult trading, maybe for the next several years, foreseeable future anyway. So probably not a market that you want to allocate a lot of capital to or waste a lot of time and effort in. Okay, the next chart here is the miners. At each one of these cycle bottoms, we hear the predictions that gold is going to go back and test the lows. And at every one of these intermediate tops, the gold bugs come out, and we hear the going to the moon. And the sad fact is that the metal sector, just like energy, is stuck in a trading range. I've been saying this for quite a while now. Obviously this was the baby bull. This was the 8-year cycle low. We are not going to go back down and test this again. We're just, all of 2017 we've been stuck in this basing pattern, and we're still stuck there. And I suspect there's a good chance we're going to go test the bottom of this trading range before this intermediate cycle is complete. Maybe even an off chance that we would go down and test the lower part of this trading range around $19 during this intermediate cycle decline. But clearly you can see we are not in a bear market. The trend is up, has been ever since the beginning of 2016. We're just like I've been saying over and over, the stock market is where the easy money is. Institutions are not going to be putting a lot of money into this market. It's in a difficult back and forth consolidation trading range. You're just not going to get a lot of institutional money willing to fight with this kind of a market. So it's going to remain stuck in this basing pattern for a while longer. The metals are waiting for the dollar to break down. And here we have the chart of the dollar, and the dollar is going to break down, but it's going to take some time. We're in a megaphone topping pattern, so you can see here the swings have become volatile, back and forth. The The fundamentals, years of QE is trying to pull the dollar down, but on the other hand, the Fed is raising rates, which is trying to push the dollar up. So you get this wild swings back and forth, up and down, as the market vibrates more and more violently, the fundamentals are trying to take hold and take the dollar down, despite the Fed raising interest rates. And I think this is going to be the last swing to the upside here, and the megaphone pattern will not retest these highs. We're going to top somewhere here, probably in the next month, 2 months, and then the dollar will roll over. It will break down out of this megaphone pattern, and we'll get the start of another bear market in earnest. So that's the big picture outlook in the dollar. And until this counter trend rally is over, and I have a sneaky suspicion it's going to be over when the Fed raises rates in December. I think that'll the dollar will roll over and begin to collapse, and the bear market will start in earnest once the Fed makes its next interest rate hike. But again, it's just going to take time. These things don't happen overnight, and until the dollar does roll over and start down, then gold is going to remain stuck in that basing pattern. And finally, we have the stock market, and clearly you can see where the institutional money is going. As I've been saying over and over, this is where the easy money is. You'll definitely get bigger swings in the energy sector or the metals sector, but it's just difficult trading in those sectors. They're in consolidations. They're back and forth. You have to time the swings perfectly to make money, and most traders are just not going to expose themselves to that kind of difficulty when there's just easy money to be made riding the stock market higher. I believe we started the vertical phase at this intermediate cycle low in August, and now this looks very much to me like we're in a runaway move. I've seen them last as long as 6 to 8 months, and if this does take off and we get a clearly recognizable parabolic move, stretches the averages 40s, 50s, 60% above the 200-day moving average. If we get 100% gain or more in the Nasdaq, then I would say we've got all the signs of a bubble, and then you would want to get out before the bubble pops. Otherwise, if this just continues this runaway move where we grinds higher, you go up a little bit, make some new highs, and we get a correction, mild correction, then a recovery, and another move to modest new highs, and another correction, and so on, then that is not a bubble. And if that were to play out, then we're looking at something completely different, which would be a brand new secular bull market that would still have 10 or 15 years to run. I'm leaning more towards the bubble phase, simply because I don't think trillions of dollars of QE by central banks all over the world, I don't think Mother Nature is going to reward that with a long-term secular bull market. I think the market is more likely to reward that kind of monetary misbehavior with a bubble and then have the bubble pop, rather than just a multi-year, 2-decade secular bull market. The last secular bull market was born with Volcker choosing the difficult path, raising rates drastically to stop inflation, triggering a double dip recession. That laid the groundwork for the last secular bull market. I don't think we laid the groundwork for a secular bull market by doing the wrong thing by printing money. I think we just laid the groundwork for another series of bubbles. So right now, my bet is that this is going to turn into a huge parabolic move, and we get a bubble top and then a collapse, as opposed to another 10 or 15 years of steady grinding higher in a secular bull market. But we'll see how this plays out. I think over the next 6 to 8 months, if the bubble is going to play out, then over the next 6 to 8 months, we're going to get a massive parabolic move. If not, if we just get this runaway move that just grinds higher with moderate corrections along the way, then I would have to modify my expectations and say that, maybe years of QE is going to produce a multi-year 15 or 20 year secular bull market, but that's not my expectation at the moment.